ain't no time to air. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew. Navigating through the markets, knowing what to do.
Let's go.
Federal reserves in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.
Never gets old. Never gets old. One more loop. Let's go, boys. Hype it up. Tap the screen, subscribe, like, go, go, go.
Chairman Powell, he ain't playing this blur. Gotta follow the data, ain't no time to air. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew. Navigating through the markets, knowing what to do. Federal reserves in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power.
Haters on the side, watch him rise and devour.
Yeah, he's the chairman of the board, making moves that empower.
It's good stuff. It's good stuff. Welcome back, boys and girls. It is that wonderful time of the month. The FOMC is upon us. Chair Powell will be speaking very shortly. Very shortly. And today is going to be, I know you've heard it before, the biggest, most important FOMC of our lives. I'm telling you right now. We got a poll going of the potential outcomes. Nothing burger is on that poll. That is not the answer. Today is going to be a something burger. This is going to be quite literally a something burger. Let's get started this way. First of all, this stream, this FOMC, is sponsored by Market Cypher. Shout out to Market Cypher. You see me trading with it every day here on the channel live. Links in the video description below. There is a promo code only available during this live stream. You can get 50% off if you sign up using it. It is Germo, code Germo. Anyway, shout out to Market Cypher. But what I do want to do is thank you guys for tuning in for another FOMC. This is the original channel, and you guys are the original FOMC community. That's right. I know you have a choice. There's everywhere. Every mainstream media, every crypto channel, every stock channel now covers this event, but we started covering it years ago when nobody cared, and we still cover it to today. So pat yourselves on the back. Thanks for being here. I appreciate you guys. If you could, smash the like button, hype up the stream a little bit, subscribe, share it out, whatever you got to do. Keep the energy going in chat. Let's go over a few things, including the schedule of today. So it is 1:36 at 2 p.m. So in about 20 minutes, we will get the interest rate decision live. It's published 30 minutes before Chair Powell speaks. We still don't know why. That's just how they do it. We have that marked up here on our chart. You can see the rate decision right here. When the candles make it over there, it will be live. We'll all Google it together. We'll try to find that decision in real time, as is tradition. And then 30 minutes after, you'll see Powell speaks is right here. The FOMC will start live. And I want to remind you, this is one of the last Chair Powell FOMCs we have. It's one of the last ones. What are we going to do? Are we just never going to say Chair Powell again? We're never going to drink every time he says inflation or I don't even want to think about it. It makes me sad. But we have only a few left as his term comes for, I guess, reappointment or is up May of 2026. And we hear Trump talking about looking at his replacements, announcing his replacements, etc. That's coming. Fun fact, he was the one who appointed him, but hey, we won't get into that. We only have about 5 of these left, so we got to make the best of them. Can I get a Chair Powell in chat? Let me get a Chair Powell. Whoever he's replaced with, I really hope he has a great name so that we can chirp him as well. We'll see. So yeah, 2:30, and then after his keynote, we will hear the question and answer, which is often the most valuable point of the entire thing. Let's start off with a warning. Today, I expect to be extremely volatile. I say this every FOMC. I don't recommend trading or really even being in a leveraged trade position during the FOMC. We have seen historically incredible volatility that typically we follow a pattern something like this. It looks like we're moving up into the rate decision, and once it's published, we tend to see that reverse, wiping out whatever gains or losses were made. And then around when Powell speaks, it tends to basically go back to where it began. And the problem is long, short, left, right, pretty much everybody gets liquidated or stopped out, and it's just a rough time to trade. So please remember your risk management. Be smart, be safe. Don't get wrecked today. In fact, that's why we do these in part, is just to entertain you during these events so you don't have to trade. Take a breather. Take a breather. So we have 20 minutes until the interest rate decision. So I think we should go into what is likely to happen today, kind of the implications of it, maybe what we should know. As you guys know, I have been a little distracted over the last 24 hours. So my homework for this is not on par. There's no TOMPOW meeting. It's not as on par as it usually is, but there isn't as much background or explanation needed, I think, as previous FOMCs. Last meeting, we had a cut. We have seen on the dot plot or the projected interest rates for the short-term future, midterm, going into the late-term future, another cut this year, even after the cut last month. That means that with almost certainty, we're going to see a cut today. It could happen in December. We could even have another cut in December. But it is almost certain that we will see an interest rate cut today. And honestly, at this point, it's largely due to the market. The market is just hot for this. It has decided that's what's going to happen. And so honestly, that's probably what's going to happen, especially considering that the Fed will be flying blind into December's meeting. They won't be getting the data, the precious, precious data that they crave so badly to make decisions. So December's meeting could be more of a nothing burger than this meeting. We see last week, this was at a 99.3% probability, according to investing.com's Fed rate indicator. That has dropped ever so slightly to 97%, and it's pretty much held there. This is a good bet. The Fed said they were going to do this, and if you look back even to the beginning of the year, they were pretty clear on this path, and they followed this path really closely. Honestly, they have not deviated from this path much. At this point, this is pretty much locked in for today. If we get a cut and nothing else, no talk of anything, the markets are unlikely to react strongly. They have been pricing this in. They've been looking at this. They've already deemed it necessary. So this is just par for the course or maintenance. I wouldn't expect too much. If for some reason we don't get the interest rate cut, that is where things will get incredibly spicy. Markets will likely react very negatively, at least initially, to no interest rate cut. I think that the odds of that are extremely low, but it's always on the table, right, guys? When we're trading or when we're dealing with probability, there's no such thing as a guarantee, no matter what. You can always have curveballs. But I'm going to tickle your intrigue here, and I'm going to tell you that the interest rate decision is really not the important thing going on today. We've been largely focused on this as a community in crypto. I don't know, honestly, for at least 4 years, probably more, right? We've been really focused on this interest rate decision. Month over month, we're waiting for it, and the rhetoric or kind of the opinion is that, okay, when we get these, we're going to pump. Well, let's look at this just briefly. Here is Bitcoin overlaid with just the Fed rate. You can see that this correlation is not really tight. It's not even really that good. We saw interest rates rise, and maybe that correlation here was the biggest part of this, is as rates went from 0 upwards to 5.5 over the course of a year, we did see crypto enter its bear market. But other than that, this doesn't really seem correlated. We've been chanting for these, hoping for these, saying, oh, we need to have bigger ones, we need to have more, and it doesn't really seem to matter, right? I mean, I'm not going to say it doesn't matter at all, but but it doesn't seem to be the golden goose that we want it to be. Interest rates continued rising until 23, and Bitcoin had met its bear market bottom and just kept going, right? Rates were flat. They finally got a cut last year, and while that cut lines up pretty well with that summer low in August, it doesn't really seem like price did anything different. Nothing different really happened. There was no real reaction to this. I think that low would have been in either way. We saw another cut last month, and remember, we did have an all-time high this month on Bitcoin, but it didn't really go anywhere. It was just by an inch. That cut not really doing anything. So my argument is that these cuts are not really what we're looking for. A lot of people have been hearing buzz about QT and QE, quantitative tightening and quantitative easing. This is likely to be the big thing in this meeting. Yeah. So this is derived at the moment, from my knowledge, from money markets. Money markets are experiencing some stress, basically driven by dwindling bank reserves because the Fed has tightened so much, so tightly, tightened so tightly. Let me see. Here we go. Here is now Bitcoin with the Fed's balance sheet. Okay, so basically when this is expanding, that is quantitative easing. And when it is retracting, that's quantitative tightening. When you look at this on the chart, it actually seems to have a much better correlation, in my opinion, than, why can't I move this? Than the interest rate. Quantitative easing began right here at March of 2020. Now, that's obviously because the markets have crashed, COVID, blah, blah, but you can see the trend. As the Fed continued to ease, markets really pumped their brains out into 2021. That came to an end, interestingly, right about the same time. Right about the same time as that Fed funds change. Note that in your brain. And as the bear market came. Now, Bitcoin has still been pumping and putting in quite a solid bull run despite the quantitative tightening, or basically reducing their balance sheet, taking out money, taking out liquidity from the system. That's what happens when we're tightening, when we're easing, putting liquidity in. And in this brief moment here, I don't actually remember this, but March of 23, I was saying this is a pretty cool correlation. You will find that in the very brief moment of easing in March, correlates extremely well to Bitcoin actually moving up. So while not perfect either, this does seem to be correlated a little bit better. A lot of people are talking about quantitative easing being necessary for alt season, etc. Maybe that's the reason you haven't seen alt season. We can speculate all day. But one thing we do know is that once liquidity is injecting back into the system, markets will likely enjoy that, at least in the short term, but more likely in a mid or even longer term than, say, interest rates. But I got a little distracted. It got off topic. The topic was money markets. So the quantitative tightening has caused stress on bank reserves. And so overnight costs for funding actually broke above the Fed's target range. So this isn't really supposed to happen, but this is a sign of stress. This happened in 2019, and we had a full-blown crisis. That's not what happened recently, but it is the same idea. It's the same idea. So SOFR overnight whatever rates hit 4.31% above the 4.25% set by the Fed, and basically, the shrinking of this balance sheet by about $2 trillion since 2022 drained reserves from the $4 trillion peak. Reserves hit about $3 trillion now. This forces banks to face tighter liquidity, and pushing this rate higher forces the banks into standing repo facility instead of lending in repo markets. And basically, this is reinforcing an easing bias that an act beyond just interest rate cuts may be necessary. Meaning, the interest rate cut that we're probably getting today, we might need, or likely do need, something more than just a cut. Now, the Fed can accomplish this by essentially ending quantitative tightening. They've talked about this over the last few months, that they were going to, or they were seeing an end to quantitative tightening. They didn't give us a date. Maybe they said kind of vaguely into next year or whatever. But they are very likely today to, at minimum, comment on it, giving us a specific or exact date, perhaps declaring that they are ending quantitative tightening in the FOMC today. That, I think, is pretty likely. I would give it maybe a 75% chance of happening. And if it does, markets are probably going to be very happy. That would be the biggest possible thing I think he could say. You could go one step higher and say that they could begin quantitative easing, or say they're going to begin quantitative easing at this meeting. I think that's a little ahead. I have a feeling that the Fed and their slow data-driven approach is going to be announcing the end of it and then in the future announcing quantitative easing. But either way, ending quantitative tightening is effectively the same as starting quantitative easing. They're going to cease to remove liquidity from the system, and they're going to have a plan setting forward to inject it. This is a very dovish, extremely dovish. As usual, we're going to watch Chair Powell. We're going to look for all of our favorite signs and signals, the words he uses, the language he uses. I don't know what color tie he's wearing, what the reporters ask. It's going to be a hell of a stream. I'm excited for this one. Hopefully you guys are too. And by the way, good morning to everyone who is not suing me. If you're not suing me, I hope you have a good morning. If you are suing me, I hope you have a bad morning. Uh-oh, I just opened Audacity. The audacity of it. My recording program. I gotta get rid of these buttons on my toolbar. I got off on a tangent here, and it was a good tangent. Ready to get back on. Actually, I did pretty good. I had much more limited time and brain. Why are we suing you? Well, check it out on Twitter. A certain someone who we're big fans of following trades of. A certain somebody sent me this message after posting. Check it out on my Twitter at TomCrownCrypto on X. Yes, if you're not suing me, I hope you have a great morning. I hope you have a great November if you're not suing me. But if you are, I hope you have a bad November. Dude, let's go. Let's do it. Come after me. Crazy to go after someone in crypto who has no skeletons, bro. I have no skeletons in my closet. My closet, squeaky. I love you too, 𝐂𝐸𝐴LEXO. Appreciate you, brother. Appreciate you, man. Shout out to 𝐂𝐸𝐴LEXO. But yeah, no skeletons, bro. I haven't shilled nothing. I didn't take money from anyone shady. I disclose all of the things that I do. I got nothing. We'll see. He's not suing, says Nimoy. Well, he direct messaged me and told me he is. So time will tell. Oh man, what a good time. I'm going to gift out some memberships of our own right here, right now. While we have 9 minutes until this rate decision is in, I'm going to gift out some free memberships to our channel because I feel like it. If you would like one, make sure you've interacted with this live stream. They are given out at random. You can't choose who gets them, but YouTube says whoever engages with the live stream will have a higher chance of randomly being selected. So that means put a message in the live chat, vote in the poll, subscribe, like, share the stream out, do all those good things that shows YouTube you're having a good time. I'll give you guys like 60 seconds and I'll give these out. Let's go. Also, put a 𝐶HPOW in chat. Now, I can't verify nor deny that YouTube will give you one if you say 𝐶HPOW. I don't know. Could be. Anything could happen. A little 𝐶HPOW. What's up, boys? Tom will become popular if he gets sued. Well, I feel like it. I feel like you're probably not wrong. It'll be a good story arc. A 𝐶HPOW, boys. A 𝐶HPOW. Interest rate decisions coming in just a few minutes. We're getting some 𝐶HPOWs in. I'm gonna gift away these memberships. First 5 are going out. We'll do more. Salute to all of you here today. Let's go. Let's go. A 𝐶HPOW. Chairman Powell. Dude, what are we gonna do when he's gone? James Wynn, lots of skeletons. Hey, I don't know. That's what you guys said. What are we going to do when he's gone? What if the guy who replaces him has a terrible last name? What if it's like Chirp? And it's like doesn't sound cool and it won't be fun to say. I'll be really sad. I'll be super sad. Let's just take it one day at a time. One day at a time. I want a guaranteed membership. Not to get it if you don't say your pal. What's up? What's up, Peach? How you doing, brother? How you doing, my friend? So let me check in on the poll here while you guys are chirpowing and give away a few more. 1,000 votes on the poll. Let's get those numbers up. I haven't looked at the amount of likes. Let's get those numbers up. 29% are just looking for a rate cut. Interesting. This is honestly the rate cut, just rate cut, to me is the most bearish scenario. It's weird to say out loud. Second to nothing. Nothing in a strange turn of events will be, in my opinion, like the most hawkish bearish thing. Rate cut, I think, is like neutral, expected, and then I think we go above and beyond today. The spicy part is all the expectations built up, and if it doesn't happen today, like it's gonna happen in December. Like there's really like no way around it at this point. Chirkov. What's up, Juanito? SEC instead of chur. I don't know, maybe unlimited dollars. That's what we're looking for. Yes. Okay, minutes until the interest rate decision is in. Really quick, make sure you've smashed a like. Checked out Market Cipher, links in the video description below. 50% off. Jumped in the Discord, discord.gg/TomCrown. Get in there, boys. Get in there. It's the best way to keep up with the streams. We are approaching the rate decision. Who's excited? 5 minutes to go to pee. Yeah, well, you can go pee. You can go pee. The interest rate decision is like almost certainly going to be 25 BPS. Like, almost certainly. We'll see. What you really don't want to miss is when Powell speaks, and that'll be in about 30 minutes. So we're still warming it up. No cuts. Get out of here. Get out of here. I see people subscribing. Welcome, new subscribers. If you subscribe while we're live, you'll see this number down here. It will move in real time. It's very spicy. Very, very spicy. I have some things planned post-rate decision, but I don't want to miss it. So here's what we're going to do. We have 4 minutes. Everyone, open up your tabs, your browser tabs. When the clock strikes 2, at the end of this hour, we're going to Google. We're going to be the first to find and report the interest rate cut. Or the interest rate decision. I'm getting ahead of myself. Remember, it can't be anything that's already published. The article can't exist already. It has to be published after 2 p.m. If it isn't published after 2 p.m., it's just clickbait. What I want you to do is Google it, Bing it, Yahoo it, Hotmail it, I don't know. And put the answer in the chat. Please cite a source. Please don't just put a number. Please don't just say no cut. Put a source. And we're going to try to see who can do it first. How's that sound? It's tradition. It's traditional. I love our traditions. Our drinking games. Drink responsibly. And only if you're old enough. But our drinking games. Can you? If I did the drinking games while streaming this, man, like I would never make it. I might die. They would like wheel me out in a stretcher by the end of it. Can't we refresh TradingView? Venus. That's not that maybe. I don't know how fast those APIs are. It's not a impossibility. It's not impossible. Let me see. Does that have to be like on a day? Yeah, I have a feeling this won't update nearly as fast as the website. Tie color prediction. Going with a purple. He's been wearing purple a lot. Been a lot of purple. Why did you hear? I'm not hunting anybody down. Someone's trying to hunt me down. Yeah, I know, right? Scary. Scary. No, I'm not afraid. I'm not afraid. I say, bring it. Bring it on. Show me your teeth. There's the tweet if you guys want to engage with it. I forgot to set my alarms. Usually I have all these alarms set for this, so that I have them in like real time when to check these things. Ooh, what if Gina shows up? Ah, Gina. Someday, Gina. Someday. You're always in our hearts. Wherever you are in Germany or whatever you're doing, I'm not sure. But you're always in our hearts and in our minds. Hopefully we'll get a new Gina, you know? I mean, like, it's about time. It's about time. Purple? Yeah, purple. Add economic events to your trading view. Yeah. Pull for Powell's color. Okay. What colors do I do? Red, blue, purple, other. This is a good poll because we still have 30 minutes. We do blue, red, purple. Stop simping? Never, bro. Never. I will always simp for Gina. Get out of here. She's my wife. Period. Gray, orange. So I do like red, blue, red, purple. Has he ever worn a red tie? I don't even remember. Who is Gina? Oh, you haven't been here. You haven't been here. Red tie is for wrecked. Thick, bright tie. Light blue. We can only do 4 different things. So let's do blue, red, purple, other. Other. Say in chat. There we go. Perfect. All right. Check the timer. Where are we at? Where are we at here? Coming on in. A minute. He never wore red. Or he wore red. Okay. I don't remember him wearing red. Either way. Orange would be the best. We are now closing in on 50 seconds until the interest rate decision is in. Are you ready? Are you ready? I'm ready. Oh yeah, I'll give out those other memberships after this. Right after the decision. Oh, I'm ready, Mr. Chirpow. A chirpow. A chirpow. What if black tie? I don't know, guys. Green would be epic. Orange would be epic. How about just a Bitcoin tie? Like, you're just like wearing a Bitcoin tie. That'd be dope. Or like a Fiat Stinks tie. That'd be funny. Can you has membership? I'll give them out after the interest rate decision. I mean, really, don't worry if you don't get one. They're just emojis. If you did get one or you have a membership, put them emojis in the chat. Here we go. Please keep all arms and legs inside the vehicle at all times. We have 1 second. It is publishing right now. Put it in chat. Put it in chat. TikTok. TikTok. 25 BBS cut. Forex Factory, that's a good source. Forex Factory. Seems like Forex Factory comes in quick. Dollar is pumping off of this 25 BPS. We have seen this in a few of the FOMCs this year. Let's see if that continues. This actually isn't quite as volatile as the last few at the moment. Let's follow this. Bitcoin down a little bit on the news. Really just responding to the dollar at this point. It did like an inverse move to the dollar. Will the dollar continue to put on gains? It does seem so for now. Let's pull these up. Gold down slightly, really similar, really similar to Bitcoin. Bitcoin recovering while the dollar still holding on to its gains. This is starting to get mixed up. Starting to get messy. No QE. Do they even announce that? I thought it was just the BPS. I thought it was just the cuts. I've never actually, because we're always doing these, I've never actually looked and seen what those articles publish. Oh, it's getting spicy. The last few FOMCs have had some pretty interesting moves while we were live. QT ending December 1st. QT endings December 1st. Where's this verified? I obviously can't look it up while I'm live. I didn't know that they gave more insights than just the cut or the decision. Interesting. That ruined some of the suspense. But okay. There it is. We were talking about it just minutes ago. So we did a poll earlier. I don't remember what percent said it, but an announcement of QT. QT ending tonight. I don't know about tonight. FOMC minutes come out in 2 weeks. In the meeting announcement. Okay. I obviously didn't get to read it because I'm right here live with you guys. Whew. Shouldn't gold pump? Well, not if the dollar's pumping. So, QT ending. Liquidity being injected is probably risk on, right? What do you guys think? And, I mean, well, gold is pumping, so I don't know. It's probably risk on. I'd imagine that's better for riskier assets like stocks, crypto. I don't know, though. Gold, it seems like all news is good news to gold lately. Dollar now giving up its shortly lived pump here. Let's take a look at gold. Did anything really happen with this change? You zoom out and it's like nothing even really happened. This is just a normal candle. Let's see if it breaks above 4,032 during the live. Let's zoom out on the dollar. This is actually a lower volatility FOMC announcement than we've seen in the last few ones. Maybe we can go back and look. We might have time. But the dollar also zooming out, really not a huge change there either. Bitcoin, the same. This really looks like par for the course here. I have a feeling that we're going to have a lot more volatility. Look at these 1 minute candles though. That's interesting. That's that volatility kicking up. Getting spicier. Now remember, for all those tuning in, I've warned you, as we always do, it's not a great idea to trade these because we commonly see Bitcoin trending into the decision. Post-decision, we tend to see it reverse. And then when Powell speaks, we tend to see it just return to kind of the median, stopping out shorts, stopping out longs, and then leaving everybody pissed. So be careful. Please be safe out there. Please be safe out there. Let's take a look really quick. Anything going on here? Market Cipher B. This FOMC stream is brought to you by Market Cipher. Sponsor today. Use code GERMO for 50% off. No, GERMO. 50% off today, only and only today. So sign up. I'm like trying to TA, but I feel like these are just going to be the worst times to look at anything. It's like anything you find will probably get stomped. 30 minute though. Looks like on the 30 minute we had a solid close, a little absorption of these sellers. Momentum's coming back up. Same on the 45. Okay, just open though. Same on the hour. Ooh. Ooh. Not bad. Not bad. Definitely went a little lower than I was looking on the last stream. We're looking at like 13.4, 13.5. Now we're down 111. Yeah. Yeah. Yeah, we'll survive. We'll weather this storm. Let's see what Chairman Powell has to say. Oftentimes the questions, the Q&A segment, after the initial FOMC speech, many times that is the spiciest. We get the most insight. Oof. Well, there we go. Bitcoin following the exact playbook that it seems to always do. My Lord. I say that, and then of course it's like, yeah, it's just like not going to do it someday. And everybody's going to be like, you're wrong. Yeah, bro, I get things wrong. I do not have a crystal ball. Just a dude. Just a dude who loves Bitcoin. He's called Chauncey Pula. What? What? Giveaway. What are we giving away? Oh, yeah. I'll give away those memberships. Here we go. Oh, I guess I gave them all away. That's okay. I'll just pay for some. It's okay. It's a little marketing budget. Gifting away a few out of my own pocket. Go ahead. You're like, but don't you get the money for them? Yeah, like 30%. So I end up losing 70%, but it's okay. It's for the love. We now have 25 minutes until Chairman Powell speaks, and he's going to have a lot to say. After the interest rate decision coming in at 25 BPS and an end to quantitative tightening, he's going to have a lot to say. It's going to be good. Before he goes live, we will rewatch the previous, it's like 5 minutes, last month's FOMC introduction. That way it's fresh in our minds and we can pick apart differences. We can pick apart language. We can be fresh as to what we're coming off of or what we're looking for, right, into today's meeting. We'll do that in just a little bit. There's a non-zero chance I just get distracted and forget. Non-zero chance. But I'll do my best not to. Yep, there we go. I've got the stream pulled up. That's ready to go. Give me a second here. I've got too many tabs open again. This is my life. Too many tabs. I thought this was interesting. So before I show this, this is not an endorsement. It's not an endorsement. I'm not endorsing prediction markets. I'm not endorsing poly markets specifically or anything. don't gamble, you know, whatever. But this is interesting and related to what we're talking about. So YouTube, please don't get mad. Play market has a lot of Powell-based bets going on. And again, do not gamble. Do not use this site. You can't even use this in the US. It's like geo-locked. But on different outcomes, will he say inflation over 40 times? You know, it would be interesting if we had like a counter for this and we kept track of them. Inflation 50 times. There's 81. People are betting an 81% chance that he'll say inflation 40 times. But then only 50% that'll say it 50 times. That those 10 extra are too many, sure. Unemployment 69%. Tariff 15 times. Meeting 9 times. Meeting. Mandate. He'll say mandate. Oh yeah. He's gonna say the word mandate. Good afternoon. 99% chance of good afternoon. What a ridiculous world we live in. Stagflation fee. I think these are just like words he says, and the people are betting on them. What a crazy world. What a crazy world. This isn't even all of them. This is just what will he say. There's $500,000 in volume just with what he will say. There's gotta be more. I'm not even gonna look it up. I don't want to risk it, but I thought that was really, really interesting. Super interesting. By the way, Play Market, why don't you try this? You sponsor me. Give me money. How many screens do I have? Way too many screens, Chris. Way too many. Haven't had a robe day in a long time. Jack, you are an OG. You are an OG. That's because it hasn't been robe worthy. Nothing's been robe worthy. I know. We did get a 25 cut, Steve, and we got chat saying an end of quantitative tightening December 1st. That's pretty spicy. I'm sure there's a bet on does he resign. What does the membership do? Kyle's Labert? Nothing. The YouTube memberships are for fun. They give you emojis and they make your name green. Yeah, that's what they do. They would say 3% inflation. No cut for what? What? Where's Asian Gina? I don't know. She was only here one time. The world is broken. Evil runs rampant. Kryptonite, my guy. What do they do? I don't know, Jonathan. I don't know that much about prediction markets. It all seems very weird how quickly prediction markets are just like flying onto the scene. Also, don't you guys find it strange? I'm just like speculating here. Wait a minute. Do you find it strange that recently there was some like NBA people got in trouble for sports bet, like rigged sports betting, but then now that prediction markets exist, isn't that like if someone makes a market of like Tom Crown takes a poop today, right? I could just not take a poop today and I could bet no. Like, isn't that just like a flood of rigged betting? I don't understand. And I am just speaking out of my understanding. I don't know how it works. It seems weird though, right? And all of a sudden it's everywhere. It is a problem. Gambling in the US is becoming such a problem so quickly. John Doe, he'll say lived instead of lived. That's a good bet. Punch your balls anytime he says data. That is a great... Alex Wells, brilliant. Brilliant, bro. You video that and you send it in and we'll watch it. We'll put it up on the screen. And they never pooped again. Has the rate cut announced? It has, Ahmed. And in 19 minutes, Chair Powell will speak live. 25 BPS cut locked in. Oh, yeah. Why do I have... that give me 1 second. There we go. There we are. There we are. I want to put on music, but I also... there's no time. There's no time. Chair Powell will be here in a minute. You guys are here. We're here. We got 3,000 live viewers. Give yourselves a round of applause. You have great taste being here. Wonderful taste. Okay, everything's locked and loaded. We haven't disconnected, thank God. Surprised. Take a moment if you haven't subscribed. Subscribe to this channel. The inventors, the original FOMC live stream right here. We got the receipts. We started doing it years ago, and everybody does it. It is what it is. But subscribe. Join our fam. Hit the like button. Hype it up. Share the stream out. We still haven't even hit the biggest, most exciting part of this. That's coming up in just a few minutes. Is the QT news confirmed? So it's an end of QT. You know, I haven't confirmed it. I can't. Oh, my guy, Mr. Market Cipher himself right here. Crypto Face. My friend, my personal friend. Love that guy. Shout out to Crypto Face, dropping it, making it rain. Making it rain. He's also the one who gave you the code GERMO, 50% off today only. So you have to sign up today. If you try to use it tomorrow, you can't do it. You may never get 50% off ever again, so lock it in. Market Cipher. It's my number. You literally see me trading here every single day using it. That's all I'm going to say. Shout out to Crypto Face. Anyway, anyways. Is it confirmed? According to chat, right? I can't look it up while I'm live. I can't confirm this. But chat is saying that this is the announcement. This is what's the input out there. So I believe it. Why Peach? Oh, you guys missed a funny comment. Lock it in, Brad Garlinghouse? What's up, Mr. T? QT ends December 1st. No signs of QE. So, Jacob, the way that I framed this before we even got this news was, okay, maybe think of it like this. So, when you are investing, you could, when you're investing, you can get some kind of guaranteed return on your funds, if, you know, like bonds, right? Or something, T-bills. But if you have debt and you have high interest debt, you could pay that debt off. And it's really the same thing as investing. Paying off debt and invest, like they're the same function when it comes to like your net wealth, your budget, the chart of your wealth. And the end of quantitative tightening is very much that same concept. It's like paying off the debt. Instead of investing, you know, getting new investments, it's like paying off the debt, the high interest debt. By ending quantitative tightening, you are de facto, you're not easing, but by ending tightening, you're accomplishing kind of the same thing. You're stopping the removal of liquidity. You haven't started to inject it yet, but you've stopped the removal, which should have the same impact, should have the same effect. It also is the perfect precursor to the beginning of quantitative easing, which I think is coming up. If it doesn't happen in Q1 of 26, I mean, hell, it could happen by the end of the year if something crazy happens. But if it doesn't happen by Q1 of next year, it certainly will happen after May, when Powell is no longer the Powellman. That's right. So it's all your hopes and dreams, maybe. But as you've come to notice, the Fed doesn't really make hopes and dreams like come true on like a quick time frame. They're very much big picture, zoomed out, long term. They're not thinking tomorrow. They're thinking next year. They're thinking 3 years from now, thinking 5 years from now. How's Wynn dealing? James Wynn said QT ends today. Well, that's cool. I mean, okay. He also said he was suing me. So, you know, man says a lot of things. Says a lot of things. Play it one more time. Play it one more time for the boys. For the boys, we got a minute. We got a minute or two. Let me see. I have an interesting thing to point out, but let's trip out.
Money machine going bird. Chairman Powell, he ain't playing this a blur. Gotta follow the data, ain't no time.
I have to get a new song.
Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew. Navigating through the markets, knowing what to do. Federal reserves in control, making moves. Keeping that money flowing so the economy can groove.
Chair Powell.
Chair Powell making paper every hour. Chair Powell, he got that money power. Data on his side, watch him rising the power. Yeah, he's the chairman of the board, making moves that empower.
Clap. boom, snare, boom, boom, clap. Love it. Markets now painting the heartbeat. The publication came in hot. Pretty much every market saw a swing low, swing high, and now pretty much everything is just right back to where it was. The dollar pumped, immediately sold off. It is slightly above where it started, but we're talking fractions of percent. Gold, heartbeat, boom, right back to where it was, down slightly. These are ever so slightly, very low time frames here. Stocks, more downward bias, but like, man, they're pretty much right back to where they were. I think the markets are waiting to hear what he has to say. I think markets are waiting for Chair Powell to come out and say it. They want to see how he's going to say it, how he addresses it. They're curious about guidance into December. How is the Fed going to operate in December's meeting? I don't know, and neither does the Fed, maybe. I don't know. I don't know, man. It's a really good question. Milk Slurper. Great. Actually, that's a great point. Right now, we have about 10 minutes till Chair Powell speaks live. Go take your bathroom breaks. Go pee. Go grab a brew. Go roll one up. Come back. Leave the stream open, obviously. But now is your warning. Go now. You don't want to miss it. Don't want to miss it. In like 2 minutes, or maybe just now, should we recap last month's? I think we recap last month's. Yeah. This is last month's intro. There's only like 5 minutes. We have enough time before Powell comes on. We're going to watch it. We're going to chat about it in the live chat, but we're going to kind of dissect it, listen for keywords, and this will be fresh in our minds for when he speaks in literally 10 minutes. So lock in, boys.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
I can't
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
How are you still confused?
The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027.
Since last month's recap.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate.
If you guys are confused,
with downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond.
There you go. Wow, how are people so confused? This giant text, last month's recap. Like, is this live? No, it wasn't live, but it was lived. So we do the recap. We like to go and watch it. One, it burns time, but two, it just reminds us what was said last month so we can compare that to what he's about to say. Because look me in the sunglasses and tell me you remembered any words he said other than good evening, good evening or whatever, good morning, and lived. Other than that, I don't know. I probably said the word tariff and inflation, interest rate, you know, whatever. It's to refresh. It's to refresh. Okay. That up. Speaking of refresh, I'm going to refresh the stream. I hate their music. I'm going to pull up the screen for their stream. Here we go. Here we are. Just 3 minutes away. What should we do? What can we do with all this time? Activities? Karate? We're going to do it live. We're going to do it live. Why will it be identical? Yeah, it will be. It will be, but some value of watching the recap. Look at that. He was literally talking last month about balance sheet runoff continuing. And now we already know that he is going to talk about the end of the balance sheet runoff. Last month, they thought it appropriate to continue and not say next month we're going to stop. This month, they are clearly going to talk about it ending in December. So clearly that implies something has changed. The data, what they look at, the economic situation has changed. You got to read in. They're sneaky. There's little details. They're sneaky with it, man. Got to look into it. Last month's was AI, and that honestly, that wasn't the FOMC. That was I forget where he was. He did the intro speech for like the atoms, whatever that we covered. And he was definitely AI. That was very strange. It's a live streamed. My portfolio is getting unalived. Yeah. Bitcoin looking real weird into this, to be honest. While it isn't that far from what we usually see, a trending move, reverse at the rate decision, reverse at Powell speak, this is kind of weird. It's kind of weird. This is not a very good looking low time frame right now. Especially off of like quantitative tightening ending. I would assume that markets would get rather bully on quantitative tightening ending.
With the free time,
I would assume they get a little risk on.
Big pumps coming.
What's up, Alpha Cry? Appreciate however much 185 AED is. Thank you for the super chat, my friend. Also, thank you for reminding me. I'm going to turn that announcement off while Powell is speaking, so that doesn't interrupt the speech for everybody. But I appreciate you, man. Thank you, Alpha Cry. With the free long. Oh, he's telling me to long Floki. I got it. I don't have time to look. I don't have time to look. And honestly, I'm not trading right now. I'm not opening a trade right before Powell speaks. I don't think I've opened a single new trade since the 10th. I think I had one or two things fill on the 10th, and I've not touched anything since. What an awful, awful time to trade. This has been awful. Just awful. Here we go. Dude, we have never seen price this flat on the 1 minute going into this. Wow. That's weird. I thought that we'd have a lot more kind of decision, a lot more confidence, market picking a direction. Show us my guns collection. There you go. There's the guns. There's the guns. The other guns, I don't show those on stream. Historically, QT ending feels initially bearish. I can see that. I mean, and look at the markets right now. Look at the markets in 2025. I would say rational responses to things are just not. Why would we even expect that at this point? Like this whole year has been totally devoid of like rational, logical. Markets are just doing whatever they're doing. Doesn't seem to matter. They're just doing whatever. We'll see. Powell going to be speaking here in any minute. Lock in, boys. Lock it in. Lock in, load it. He's always fashionably late. There he is. Liberty claps. Everybody shut up.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina, only Gina, nobody else, no one else, just Gina. I don't care. If she's not here, then no one asks a question. You're not Gina.
Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So
Not foregone.
I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook? Or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Short-lived. Ooh.
Claire Jones, Financial
Claire
Times.
Jones, our favorite.
Thank you
Hello,
for taking
Claire.
this question.
Hello.
We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns and some will be more averse to underruns of employment. And so you put that together. And as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the beige book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the beige book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
December's meeting is like a box of chocolates, to clarify. Chair Powell.
Steve Leisman, CNBC.
Drink.
Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
For good luck.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut.
Mr. Powell, what did you vote
for? Differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet.
Well said.
If you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percentage of GDP and become a tightening factor?
Yes.
So
yes,
you're right.
Tighten,
The place
you're
we'll
right.
be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point. That's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet
to buy Bitcoin.
Right now, it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Shrinkage? Question mark. Mr. Powell, shrinkage?
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%.
Good question.
So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs. The thing about tariffs might be 2.3 or 2.4 in that range. something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
What about the
inflation.
PP shrinkage again?
Well,
one more time. Just
again,
run that
the
back.
part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world.
Get them out of my neighborhood, though.
Big U.S. companies are
CME gap closed.
just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Gina. That's not. It's a weird way to spell and say Gina.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing.
Someone tell Elon Musk.
We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction in rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, perspectives on people on the committee that, we've now moved 150 basis points. Yeah. And that we're down into, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed.
Neutral rate is so, like 100 points down now. That's it.
For some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read.
Use the word
so
lore
people
correctly.
just have, again, we've cut 50 more basis points
All right,
in the
Powell.
last two meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
I'm just telling you. I'm just telling you. I'm just telling you. I'm just telling you. I don't know.
Thank you so much. Elizabeth Schulze with ABC News.
I like that.
What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So
I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply. I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates, and we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were, and that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
I agree.
You also talked about tariffs causing a one-time price increase.
Sure.
Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
You already commented on that, but
The basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are 1/10 or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something.
Once the last tariff, the final tariff.
It becomes a higher price level, but it stops going up. If you will, prices stop going up, they'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
When will the last tariff
from Bloomberg Television and Radio.
The final
Do you have
tariff.
any concerns that equity markets are or are close to being overvalued at this point?
Good question.
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not.
A picture.
It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers or may be skewed that way. But the consumer is spending, and that's a big, big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
They should be doing the last question soon.
Hey there, Andrew Ackerman with the Washington Post.
No genus.
I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Ready for a nap. Brian.
Hi, Chairman
Gino.
Powell. Brian Chung with NBC
Sure,
News.
pal. Take a drink.
Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we do get we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, there's no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel. Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Yeah, last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Thank you very much. Thank you very much. Thank you very much. There we go. Chair Powell in his glory. Man, we only have. I don't even want to think about it. A few more left with him till we get someone else, and hopefully he'll fill the shoes. We got 25 BPS cut. We got December end of quantitative tightening, and we got I don't know, a lot of talk, a lot of fluff in between. It was by far the biggest, most important FOMC ever. The dollar apparently enjoying this. Bitcoin kind of back to where it was. We saw assets overall sell off. Was a great time. I appreciate you guys tuning in. Make sure you've liked and subscribed, tuned in for more. We'll be live Friday for more spice. Make sure you jump in the Discord, discord.gg/TomCrown. If you're looking for an exchange, check out our partner, 𝐒𝐈𝐆𝐍. Links in the video description below. Lots of perks for using my link. And of course, shout out to our sponsor, Market Cipher. My guy, CryptoFace, in the chat today. Good to see you, brother. There's still time, but not a lot of time. Sign up with Market Cipher. It's my most used crypto tool, trading tool on this channel. Use code. For some reason, I keep blanking on it when I go to say it. It's there. Germo. Code Germo for 50% off. That will expire very, very soon. You still have a little bit of time. I appreciate you guys tuning in. I hope everybody who is not suing me has a great day. I'll catch you